Hello and welcome to Moneylife. This is Sucheta Dalal. This week, naturally, we're going to talk about this big bombshell by Viceroy Research about the Vedanta group. Now, Vedanta is not as high profile as Adani or Ambani, but it's listed overseas for a while, got delisted in 2018, and it's got operations all around the world. So, ever since Vedanta listed in London, in fact, Anil Agarwal, its promoter and founder, has carefully crafted an image of a self made man, resilient, socially conscious, who has clawed his way up from scrap metal trading to helm a global mining empire. It's a seductive story of humble origins, daring bets, resilience, philanthropy, and commitment to nation building. Really important today. For decades, this narrative has helped counter many financial, environmental, and governance controversies that the group has been involved in. It has helped bankers and regulators look the other way, avoid deeper scrutiny of this metals and mining conglomerate, which includes multiple global subsidiaries, intermediate holding companies under what is Vedanta Resources Limited, which is the parent. Now, 9 July, Viceroy Research, which is a short seller, declared short seller, exactly like Hindenburg, produced an 87-page report, put it out in the public domain, and it was a bombshell. In fact, it blasted this beautifully crafted narrative in words that are strong, especially by Indian standards. You don't hear this kind of language ever in the Indian media. This company, Viceroy, is a forensic research firm which also invests. Now, what are its allegations? Viceroy alleges, mind you, bombshell. So Viceroy alleges that Vedanta has a Ponzi-like structure. What is a Ponzi? You get new money to pay back old money. So in this case, he says it's a Ponzi-like structure propped up by a continuous cycle of new debt in order to remain solvent. It calls the group parent company, Vedanta Resources, a parasite, which is draining the publicly listed Vedanta Limited and its subsidiaries to keep what was once the London listed parent afloat. Viceroy's key contention is that Vedanta Resources survives solely by forcing the listed entity, Vedanta Limited, to issue massive dividends which are funded not by profit but by further borrowing. And yet, because Vedanta Resources, the parasite parent, holds 56% in Vedanta Limited and smaller stakes in other subsidiaries, these high dividends don't go just to the parent. And it says they leak out to smaller subsidiaries and minority investors, which means you need larger and larger payouts in order to meet the parent's obligations. Viceroy report puts Vedanta Resources gross debt at 4.9 billion as of FY 24-25, and that of Vedanta Limited, including Hindustan Zinc, at around 6.7 billion. This is huge, over 11. It also says that the real total group debt could be even higher because of undisclosed or off-balance sheet items. This is one part. Apart from this, it says there are a staggering number of legal and regulatory challenges that Vedanta's key operating subsidiaries face, and it has done a comparison with a peer group. In fact, they reveal, and I quote, a portfolio riddled with financially unviable assets, undisclosed liabilities, systematic fraud, and profound governance failures, close quote. In fact, Viceroy calls the book values reported by Vedanta Limited as pure fiction. Vedanta's response has been to dismiss this outright, calling it false propaganda, and to question the motives and timing of the report. And in India, we seem to think all short sellers are bad, so Vedanta seems to be getting away with it without refuting any of the specific allegations spread over 87 pages. And you can read our report at Moneylife. Here's a link. Now, those of us who've been watching this group for decades, there's a dismal sense of deja vu. This is not the first time that the group has been accused of treating public shareholders badly or as a funding mechanism for private control. In fact, the big controversy was on 2012 when it announced a merger of two subsidiaries Sesa Goa and Sterlite Industries to form Sesa Sterlite. There was a lot of anger, a lot of protest, but it was rammed through. At that time, proxy advisor in Govern said this was essentially a strategy to dump 5.9 billion worth of debt and a collection of struggling aluminium assets onto the more transparent Indian balance sheet of these two companies combined. In Govern, of course, is singing a different tune today. But be that as it may, it has now attacked the Viceroy report as a typical playbook of short sellers, establishing short positions, publishing critical reports, amplifying findings via media to trigger panic and profiting from price declines. But I didn't see much to counter the points that they have made. It talks vaguely about needing better governance and disclosures. So nobody has countered these 87 pages as yet. Coming back to Vedanta Resources, the London listed parent company, delisted in 2018, had then transferred its stakes to in Kane India, Vedanta Aluminium, and Madras Aluminium Company to Sesa Sterlite. This happened despite objections of minority investors. And why did it get away with it? Because Mr. Agarwal held 58% in Sterlite and 55% in Sesa Goa. So the transaction was rammed through. This conveniently moved a large chunk of VRL's liability into the profitable merged company. That was 2012. We are in 2025 now. And this has become a template because each time the commodity cycle turned down or debt began to pinch, Vedanta announced a new restructuring plan draped in the language of consolidation, synergy, simplification. Each time, control remained firmly with Mr. Agarwal, while risks migrated to lenders and public shareholders. What are they doing? We'll come to that. But before that, let's go back to the history of Mr. Agarwal and Sterlite. I'm going back to 98. In fact, when scam accused Harshad Mehta, responsible for the 92 scam, was trying to make a comeback, he chose three companies: BPL, Videocon, and Sterlite. Yes, Sterlite. As the three companies that he was going to ramp up to stratospheric levels, exactly like he had done a bunch of stock, and to come back as a market wizard. It ended in disaster, with the Securities and Exchange Board of India launching a huge investigation because stock prices fell first, and it discovered, this is a SEBI investigation, not me saying it, how Sterlite had routed money through intermediaries to corner its own shares. If that weren't enough, because everything collapsed and the Bombay Stock Exchange, which was the biggest exchange those days, did not want another embarrassing controversy like 92, they surreptitiously opened the mainframe BSC computer at midnight to insert trades at pre-negotiated prices, and Sterlite was involved in this as well. Again, not my words. This was a finding of the market regulator. It's a telling commentary on our regulatory system that while SEBI has done this investigation, it has not stood in the way of anything that Mr. Agarwal did, including his global expansion, global listing, growth, buying public sector companies, nothing. Regulators quite happy to look away, and banks even more so. So now let's look at the debt spiral. The demerger proposal announced last year, 2024, is no different in spirit. Viceroy contends that Vedanta's plan is to spin off multiple businesses, aluminium, power, oil, and gas, ostensibly to unlock value, but it won't do this. It will simply shift liabilities from the holding company to the newly listed entities. And these entities will be debt-laden from birth. In Viceroy's telling, the group's combined debt is not the officially acknowledged $11 billion plus, but likely to be far higher due to undisclosed liabilities, intercompany guarantees, and questionable asset valuation. Its report accuses the management of systematic looting of Hindustan Zinc, including related party transactions and inflated brand fees. Today's Economic Times says the Hindustan Zinc board is threatening to resign, but let's see if anything comes out of it. We have seen and heard this. I'm going back to 98. Now, Viceroy's scrutiny does not stop at finances. Viceroy says Vedanta's auditors in India and abroad are a patchwork of small firms, many of which have been fined or sanctioned for professional misconduct. The group's main auditor in London, MHA McIntyre Hudson, was censured for poor controls and failing to flag regulatory breaches. Interestingly, Vedanta is its largest client. That tells you something. Several overseas subsidiaries are audited by a two-partner firm operating out of Bhiwandi and out of a single apartment in Bhiwandi using a Hotmail address. The implications are clear. If these allegations are substantiated, India's largest nationalized banks, whose balance sheets have just been cleaned up at our cost through the exchequer, and massive write offs are again staring at a slow motion train wreck. These include State Bank of India, Bank of Baroda, Punjab National Bank, IDBI Bank, Bank of Maharashtra, and of course, a clutch of private banks, the biggest ones. They together have an exposure of 30 to 40,000 crore, which is not small peanuts. Where are the regulators in all this? Will Viceroy's investigation lead to deeper scrutiny? Forget about the short selling part. In the past, Viceroy's exposures of Germany's Wirecard, which was a multi-billion euro fraud, led to serious regulatory action. Remember, Vedanta has not come up with a detailed point-by-point rebuttal other than saying it's malicious and timing. So the most remarkable part of this saga is how India's regulatory and supervisory ecosystem appears completely neutralized. Despite decades of controversy, from share price ramping during the Harshit Mehta time to the controversy over Sesa Sterlite and the attempts to delist Vedanta on the cheap, we haven't even talked about Mr. Agarwal's group has encountered no regulatory resistance. Even after this explosive expose, our regulators are silent. SEBI says to NCLT it's doing some investigation, but not after this report. Ministry of Corporate Affairs is silent. The National Financial Regulating Authority, which should be looking at auditors, not a sound from them. No investor group or analyst has questioned bankers who lend to this entire group because they are the ones in the front line of trouble. In fact, banks are forever eager to lend to politically connected business tycoons, while credit rating agencies, their revenues depend on repeat business, remain quiet. You've seen the number of times ratings have collapsed from A to D overnight. Proxy advisors, well, InGovern is the only one talking this time, and it's done an about turn. Now, Vedanta is not small. It's got humongous assets, India's largest zinc and aluminium operations, substantial oil reserves, and it has ambitious plans for minerals globally. That means what it says needs to be investigated because it's big and it's important to the nation. But the pattern of financial re-engineering is unmistakable. Each restructuring is framed as a rational exercise of consolidation and simplification. The result is more liabilities accruing to investors and creditors, and of course, serious governance issues, opaque structures. All this is covered up by lavish advertising campaigns. Now, you would wonder why advertising campaigns? It's not just about a PR exercise to burnish your image, but the money you spend silences most of the media. Then there's the mirage of philanthropy. Mr. Agarwal is constantly talking about giving away most of his wealth. Sounds surreal, but he is actually a signatory to the Giving Pledge along with Bill Gates and Warren Buffett, promising to donate 75% of his fortune to charity. Now, the bulk of that fortune itself is pledged as collateral for a mountain of debt. What exactly is going to be given away? Now, if a company finances dividends and borrowings and channels cash to debt-ridden parent companies, who ultimately bears the burden? Answer is simple. Creditors, minority investors. Minority investors have repeatedly paid the price. Creditors, if they're nationalized banks, even the taxpayers pay a price because they're recapitalized. Now, how have minority investors reacted? Well, on the first day, there was panic. Stocks crashed, fell 8%, recovered a little later. So there was a reaction that day. But remember, the bulk of promoter shares are pledged. In fact, that's an indicator of trouble, which means that unless the lenders with whom it's pledged take a decision that we are now going to sell, which rarely happens except in extreme circumstances, the stock price remains because there's not enough stock coming into the market. Also, a day after Viceroy's revelations, Mr. Agarwal was confidently holding an AGM and announcing plans to double oil and gas production, investing in new smelting complex, and what have you. So, the signal out there for those who don't want to dig deep is it's business as usual. Nothing's going to happen. Yet another short seller. The lesson, as in so many Indian business sagas, is that lavish image campaigns tend to silence critics and buy media clout, and retail investors may not get carried away. The smart ones will vote with their feet, but the cost of credulous lenders who fail to fulfill their fiduciary obligations and responsibilities is ultimately paid by the entire system in the form of write offs and government funded recapitalization of banks. So, before you ignore all of this and say it's just a bunch of short sellers, think deeply, because it's not about whether you're an investor or not. All of us pay the price when something goes wrong, and things have been going wrong. We have seen it since 2018. Many of you watching this have paid a price. If you agree, please share and subscribe to this channel. Thank you.